In the intricate world of high finance, where fortunes are won and lost on the whims of market forces, a bold gamble is unfolding. Hedge funds, those daring investors known for their audacious bets, have amassed their largest wagers against European government bonds in over 2 years. Their objective? To capitalize on the European Central Bank's perceived limitations in further lowering interest rates this year. The data speaks volumes. The total value of bets against European government bonds has swelled to an eye-watering $413 billion this week, according to figures from S&P Global Markets Intelligence. This figure, measured by the bonds currently out on loan, marks an 8% increase since January and the highest level since April 2022. It's a bold move, one that underscores the hedge fund's conviction in the ECB's restricted maneuvering room. The timing of these wagers is particularly noteworthy, preceding the ECB's widely anticipated 0.25 percentage point interest rate cut from a historic high of 4% on Thursday. However, the central bank's accompanying actions have only fueled the intrigue. It raised its inflation and growth forecasts for the remainder of the year, a move that seemingly contradicts its rate cut decision. Moreover, the ECB removed an explicit easing bias from its monetary policy statement, leaving observers puzzled. Robert Tipp, the head of global bonds at PGIM Fixed Income, offers a candid assessment. The big picture here is that inflation numbers had been coming down but had a nasty uptick. In my opinion, they made the mistake of signaling and boxing themselves into a cut even though the data was suggesting they should have held up. The crux of the matter lies in the Eurozone's stubbornly persistent inflation. After a brief respite, it rose for the first time this year in May, reaching 2.6%, with services inflation climbing to a 7-month high. The ECB's revised predictions paint a sobering picture. Inflation is expected to average 2.5% in 2024 and 2.2% in 2025, though easing to 1.9% in 2026, still shy of the coveted 2% target. In a bid to justify the rate cut, ECB President Christine Lagarde cited policymakers' confidence in the path ahead. However, she stopped short of confirming a broader dialing back phase, stating that she wouldn't volunteer such a notion. The markets, ever attuned to the slightest shifts, have adjusted their expectations accordingly. Investors now price in a 76% chance of the next rate cut by September, a stark contrast from just a month ago when another cut by then was considered a certainty. The German government bond market, the benchmark for the Eurozone, has witnessed a 10% surge in short positions since January, reaching a staggering $112 billion. Consequently, yields on 10-year bonds have risen from 2.1% to 2.5%, reflecting a decline in prices. However, the most significant increase in short positioning has occurred in the Italian bond market. According to S&P's data, the value of Italian bonds borrowed by investors has skyrocketed by 38% since the start of the year. This development suggests a waning confidence among some investors in the rally that had narrowed the gap between Italy and Germany's benchmark borrowing costs from 1.65 percentage points to 1.31 percentage points since the year's inception. Amidst this backdrop of uncertainty, other measures of investor positioning offer a glimmer of optimism for European bonds. Bank of America's monthly fund manager survey revealed that asset managers were slightly overweight European bonds relative to their benchmarks. Yet, not all are convinced. Alex Batten, a fixed-income fund manager at Columbia Threadneedle Investments, expressed a preference for holding U.S. government debt over European debt, stating, "Europe will not be immune to the U.S. experience of inflation taking time to recalibrate back to target." As the curtain falls on this financial drama, one truth remains inescapable: the path ahead is littered with uncertainty. The hedge fund's audacious wagers against European bonds represent a calculated gamble, one that could yield handsome returns or costly losses. Meanwhile, the ECB's delicate maneuvering between economic realities and market expectations will continue to shape the narrative. In this high-stakes game of chance, where fortunes hang in the balance, only time will reveal the victors and the vanquished. And as the financial world watches with bated breath, the hedging gamble continues to unfold, a testament to the ever-evolving dynamics of global finance.